You open your investing app. Your stomach drops. Everything is red. Your portfolio is down 18% in a week. And the news is screaming. Trillions of dollars wiped out. You sit there thinking, that's my money, disappearing in real time. You didn't gamble. You didn't day trade. You just invested like everyone told you to. So why does it feel like the system just reached into your account and took a piece of your future? If that thought has ever made you stare at your screen in disbelief. Yeah, that's most people during a crash. My name is Noah, and I spend way too much time thinking about market psychology and investor behavior. If you're someone who checks their portfolio during downturns and feels fear, regret, and the urge to do something, make sure to hit subscribe and give this video a thumbs up if this helps you out, because today we're answering a question almost nobody asks. When a stock market crashes, where does the money actually go? Did it disappear? Did someone take it? Or was it never really there? Look, understanding this changes how you see crashes forever. Every crash comes with the same terrifying headline. The market lost $2 trillion in a single day. That sounds like someone backed a truck up to Wall Street and drove away with $2 trillion in cash. But that's not what happened. Here's what most people don't realize. Market losses are mostly changes in price, not money physically leaving the system. The stock market is not a bank vault. It's an auction. Every second of every trading day, buyers and sellers negotiate prices. If buyers are confident, prices rise. If buyers are scared, prices fall. That's it. No vote. No pile of cash. Just changing opinions about value. Let's say a company has 10 million shares. Yesterday, each share traded at $100. Total value, $1 billion. Today, fear hits the market. Now shares trade at $80. New value, $800 million. But no one withdrew $200 million. The only thing that changed was the last price someone was willing to pay. Think about your home. Last year, a realtor told you it was worth $500,000. You felt richer. This year, the market cools. Now it's worth $450,000. Did $50,000 leave your bank account? Of course not. Nothing moved. The only thing that changed was what someone is willing to pay today. Stocks work the same way. Now, you might be thinking, my portfolio is down. That's real. Emotionally? Yes. Mathematically? Not yet. You only lose money when you sell. If you bought a stock at 100 and it falls to 50, your account shows a 50% loss. That's a paper loss. You still own the stock. But the moment you panic and sell at 50, you turn 100 into 50. You lock in the loss. Here's the part the headlines ignore. For you to sell that stock at 50, someone had to buy it at 50. While you were panicking, someone else stayed calm. Maybe a pension fund. Maybe a long-term investor. Maybe someone who had cash ready and was waiting. They looked at the same stock and thought, this is on sale. This is where it gets really interesting. Market crashes are not money destruction machines. They are wealth transfer events. From panic sellers to patient buyers. Imagine a crowded room. Someone suddenly yells, fire. Everyone panics and rushes for the exit. In the chaos, they drop their expensive jackets on the floor. The people who lose are the ones who panic and abandon their valuables. The people who win stay calm, bend down, and pick up the jackets. That's a market crash. If money isn't disappearing, why do crashes feel so violent? Because of three powerful forces. First, fear spreads fast. Humans copy each other. Losses feel about twice as painful as gains feel good. Second, forced selling. Some investors borrow money to buy stocks. If prices fall too much, lenders demand more cash. If they can't pay, their stocks are sold automatically. This pushes prices lower, triggering more forced selling, a domino effect. Third, liquidity disappears. Buyers step back. Temporarily, it becomes hard to sell at fair prices. The money isn't gone. The buyers are waiting. During a crash, money rotates. It flows out of risky assets into things that feel safe. Cash, government bonds, gold, money market funds. The money you thought was destroyed is often sitting on the sidelines, waiting for the panic to end. Look at the 2008 financial crisis. The market fell more than 50%. If you checked your account in early 2009, it looked catastrophic. Many people sold near the bottom. They locked in losses, but others were buying. Institutional investors with cash, retirement funds rebalancing, ordinary people who stayed calm and kept investing. From 2009 onward, the market entered one of the greatest bull runs in history. The money wasn't destroyed. It changed hands. Here's what most people don't realize. Crashes don't destroy wealth. Panic does. Your biggest enemy isn't the market. It's the urge to escape discomfort. Selling feels like relief, but that relief often locks in long-term damage. Now you might be thinking, what if this time is different? Fair question. Markets can take years to recover. Some companies fail. That's why diversification matters. Not blind optimism. Preparation. Here's what you can do. Stop checking your portfolio every day. Build a cash buffer. Automate your investing. Reframe crashes as sales. Know your risk tolerance before the crash, not during. When the next crash comes, and it will, ask yourself, do I need this money soon? Do I have cash reserves? Can I afford to wait? If the answer is yes, the scariest moment in the market might become your greatest opportunity. The market doesn't delete money. It transfers it from the impatient to the disciplined, from panic to patience. Your portfolio value is not your bank balance. It's today's auction price, and auctions change. If this helped you see market crashes differently, hit like and subscribe so we can keep making money make sense. Thanks for watching, and I'll see you in the next one.